welcome to One and the Assay. Today I'm here with Hedley Widdup, manager at Lion Selection Group. So Hedley, thanks for joining me today.
Hey, Amy. Thank you very much for having me. I hope you're well.
Yeah, very good. Thank you. So let's, this is going to be for the ASX edition of the Assay. So we're going to be talking a bit about kind of what's happening in Australia, but also your views overall on the markets. So Lion Selection is very famous for your investment clock, which you spoke about in the last time that we did one of these interviews. Can you maybe give us a quick update on maybe what the investment clock is for those who don't know and where we are now?
Yeah, sure. So the investment or the mining clock, I guess, or the Lion Resources clock is a concept which is probably now 3 decades old, and it's a cartoon which is used to explain the liquidity, which is money being invested in or being taken out of the mining space, and this causes share prices to go up and down, and it leads to the boom bust shape of mining cycles. So when the mining boom is at its absolute peak, that's 12 o'clock midnight, if you like. When the crash starts, it starts to go down the other side through 1, 2, 3 o'clock, and the new boom starts when fresh liquidity starts to come back into the sector properly again at 6 o'clock, which is the bottom. So it doesn't move rhythmically, it doesn't move regularly. It can move very quickly through parts and then slow down in others. And in 2022, we had the big hand and the little hand both pointing straight up. So it was 12 o'clock midnight there. I think when we were aligning the clock at that time, I think we'd already passed the peak of share prices. But what we weren't sure of was whether or not this was going to be a sharp peak with a sharp equity market correction on the back of it. And we thought, well, you probably won't really see the trouble start until the equity market starts to panic. We haven't seen that. I mean, we've seen a lot of volatility, but I think we can say very, very certainly now that there's an awful lot of liquidity has left the mining space. We've seen commodity prices soften, more or less along the same sort of timeframes as what we're talking about with equity prices. We've seen the equity prices of the bigger mining companies flatten or even round off. And in junior space, right at the small end where the micro cap explorers are operating, we've seen their share prices in most cases halved, I think is a median measure of most of them, but it's much, much worse than halved in some cases, and some of them are just okay. So this has led to an inability to raise money. So we're sure that it's past 12. What we haven't done is come up with an accurate read on the time, I guess. So my feeling is it's probably somewhere between 2 and 3 coming down the other side. But I think what we really want to get our heads around is how much further the equity market and the impingement of inflation, interest rates, and the Chinese economy will have on the resource equities space before we make a confident call on that. So coming down the other side, I think, is as best as I can tell you at the moment.
All right, sounds good. And then, so that's kind of a really kind of good overview of the cyclical kind of nature of mining and the external forces. What's your outlook overall for commodities? So, I mean, are there specific winners or resources that are standing out to you right now? I suppose what's most of interest?
I think longer term, the fundamentals for just about everything are wonderful. So we're looking at the market and thinking some of the things we're looking at are cheap. The commodity price long-term fundamentals are great. It might get a little bit cheaper in the meantime, but these are opportunities which we can take advantage of, feeling like we're investing through the bottom. And equities are driven very strongly by a commodity price lead, right? So we're in the spaces where we've put money so far, we see that as having a play out which makes sense for us. But generally speaking, I mean, these long-term fundamentals are great, but commodity prices generally are being impinged by things like the Chinese economy. So if it's a commodity which is consumed, like copper or even lithium, we've seen softness in those prices. And that, to some extent has led the equities in various spaces. I think copper has probably had a much stronger feed through to copper producers, and iron ore has had a much stronger feed through to iron ore producers. In the lithium space, we've seen M&A activity. We've seen a continued market sentiment, which is very, very enthusiastic towards lithium. So whilst lithium price guidance has softened, and pretty reasonably, I would say. The lithium equities still hold up. And I mean, we still see deals where an explorer acquires a piece of ground which is highly prospective for lithium, and they get a share price reward for it, when, you know, if, even a week before they've put out high-grade gold results which haven't moved the needle at all. So I think those are pertinent points. Long-term outlook good, short-term not so sure, and that's because of the Chinese economy. But as for favourites, look, lithium had been a great place to be able to find something, because I think you get an instant reward. But longer term, my favourites are more along the lines of gold, copper, and they're both fairly low risk as far as separation and marketing of the product. Lithium for sure, but it's a careful and medium-term play. I think they're trying to get involved in the right thing. And then things like nickel, manganese, zinc to some extent that are exposed to the new and old world economies as we go through the next decade or so. I think there'll be excellent demand for those products, and they're the kind of projects which carry lower levels of development risk.
Okay, yeah, absolutely. I mean, you started to talk a bit about kind of what the demand would be for some of these kind of new energy metals. So, you know, one of the biggest stories has been in supply and demand is about this kind of this looming lack of supply for a lot of the key battery metals. And, you know, part of this is further exploration, but financing is a huge factor there. So looking at Australia specifically, do you find Australian juniors are faring well compared to others in the market? So kind of geographically speaking, you know, is the money coming into Australia and Australian projects?
Yeah. Look, there's very strong reason to think that Australia is still an attractive jurisdiction like that, and it's undoubtedly easier to do something in Australia if you want to explore for gold, or if you want to explore for copper, if you want to explore for lithium. Your pathway towards production is far more certain than it is in places like Africa or Asia. I mean, just look at what's happened with Leo Lithium in the last couple of days. It's a great example of how foreign jurisdiction nationalisation risks can impinge quite strongly on project developments and the value of assets and the rewards to shareholders. So those kinds of things are unheard of in Australia. But in large stable jurisdictions, you get a very strong overprint of ethics, I suppose you would say, and government policy, which might or might not be created by people who understand the influences on the flow of capital in and out of the country. So in parts of the Australian industry, we've seen new legislation towards Aboriginal heritage protection in Western Australia, which I think was well-meaning in terms of protecting the right things in the right way, but was extremely heavy-handed in the way that it was aimed at the scale of activity that would provoke the necessity of a clearance, a heritage clearance. So, you know, it was not aimed at miners, it was aimed at miners, farmers, private landholders, property developers, you name it. And in a lot of cases, you know, it was to the ridiculous extent, you know, in areas where you could almost certainly say that there was not going to be anything that was necessary to assess, still required an assessment. So, you know, that has become a problem, I think, in Australia. That legislation was repealed, but I think it just shakes the confidence. And at a time when the market is weak, it doesn't bode well for money coming into Australia, particularly if you're thinking about some of these. I mean, if you just compare the fledgling lithium industry, that's not a bad one. Australia is arguably 2 or 3, maybe 4 or 5 years ahead of the likes of Canada in developing new mines and having production of lithium. Canada has very similar geology, so granites that intrude old rocks and the pegmatites that carry spodumene, and those are one of the favourite sources of lithium in the mining market. There have been mines developed in Australia, and there will be mines developed in Canada, and they're two competing jurisdictions. In Australia, particularly in more remote parts of Australia, you need to provide your own power. So, you know, grid power in Perth might cost you, as a commercial user, 9 or 10 cents per kilowatt hour. It might cost you 30 to 40 cents, depending on how you generate it and where you are in the world, if you need to generate your own power at a remote mine site. So, you know, circa 3 to 4 times the amount for power, which is a very, very substantial input to most resources projects. In a lot of parts of Canada, the same projects or the same sorts of projects are often able to access grid power, which is hydro produced. So it's not only green in terms of being zero emissions, it's also about 3 to 4 cents per kilowatt hour. So instead of being 3 to 4 times more expensive than capital city grid commercial power rates, it's about half of what it is the Australian power rate. So there's a push and pull there, and I think that will probably see some capital drag towards the greener solutions for some of these new world metals, and there's definitely going to be a premium that can be paid for those kinds of things. But investors globally, I think, are far more concerned about nationalisation and things like that. So that still favours Australia as a top jurisdiction, and it won't fall far behind Canada on those bases. For that pure reason, you won't lose your project in Australia.
Absolutely. I mean, do you see that push for nationalization as making more investors focus more on Australia, at least Australian-based investors such as yourself?
Yeah, I think over the past, let's say, decade or so, it's probably a bit longer than that since the GFC, and there was a mining bust which started in 2011, which saw a lot of money come out of the mining market. It found its way into other sectors. But as that money has come back, I think some of the places where it had been burned or had scar tissue was where it had invested it in jurisdictions that were a little bit edgy. And outright nationalisation of assets is rare, but nationalisation via tax or via royalties or via project shares or via blockages which stand in the way of permitting, which lead to wholesale transfer of value, either as anything from a cash payment to a project share. These things are all uncertainties which investors are very, very nervous about, and they've become far more common, I think, in many parts of Africa in particular. And I don't really blame some of those governments for the way that they stick their hand out, because they would probably have a strong argument to say that the development of a mining industry over multiple decades in some of those countries has enriched individuals, but it might not necessarily have made life better for a lot of the people who live there. And that's just a very common thing in some parts of the world, that benefits and riches tend to flow a little bit more focused fashion than they do in other countries. I think that's something which Australia gets highly rated for, is this very transparent rule of law, maybe a little bit heavy-handed and overly applied in some cases, but tends to be pulled back when it overshoots. And that's something which still attracts investors. And it, between Canada, the rest of North America and Australia, they are by far the best jurisdictions for mining, and paired with the best geology globally as well.
Yeah, absolutely. My last question is really just kind of looking at, projects, or what your criteria for making a potential investment in this space, looking at ASX or Australian juniors, is it this commodity, is it this risk management? Like, what are kind of some of your key criteria that you like to use and focus on when looking at projects?
Yeah, well, I guess we're doing this at the moment with the backdrop of we've exited a couple of fairly significant investments in the last 2 or 3 years, which have netted for us about $95 million. We've dividended a small amount of that out. So Lion sits there with a reasonable amount of cash to invest. And I think you'd say that our mentality around that is not to deploy all of that at once. So there's a degree of diligence and care which needs to be employed over the top of the choosing of those investments. And I only mention that because it sort of pushes those criteria right to the top. If we were replacing one thing out of the portfolio with another, you might go looking for something similar to fill a gap. But at the moment, the whole portfolio is a gap, if you look at it that way, that we want to develop a portfolio which is commodity diverse, which is focused in Australia, and has, I suppose, a spread of exposures from early stage, where you can get exploration upside as a form of reward and value add in the portfolio, right through to project development, where the return of value is shorter term and is possibility of turning into a cash flow and possibly even a dividend stream to the fund. So what we're looking for is, I suppose, diversity across commodities which are obtainable or can be developed as greenfields projects by standalone companies. So we want to see projects developed in our portfolio. We might not own the whole thing like a BHP or a Rio Tinto would, but spread across a variety of commodities. Now, because we're doing that as an investment vehicle and not as an 100% owned vehicle, we can't be investing in infrastructure which enables that. And the likes of Rio Tinto are in things like iron ore, which is very dependent on infrastructure, ports and railways and things. So we steer away from those. They're quite capital intense for startup businesses, and we're much more firmly focused on projects where the degree of development risk carries far less metallurgy and marketing risk. So things like gold, easy to separate, easy to sell. If I had a piece of gold in a piece of rock, I could probably separate it in the office, and I might be able to sell it by the time I get to the top of the hill. It's pretty easy. Copper, nickel, concentrates are traded globally and frequently. So there's a very, very broad and liquid market for concentrates in those things. Lithium, growing market, but currently quite high margins are available for the sale of concentrates. So that's an attractive business to us, although it's not one that we want to dive into, rush into. We still want to understand the qualities of the projects. And things like zinc, magnesium, silver, I didn't mention before, find very interesting. So there's a whole range of them, which they're just less common projects in Australia, but still very attractive to us. And what we want to see in those is a reasonable size of inventory. So whether that's defined in a resource or just something that we have to apply our minds to and decide that we can see, we want to see the sorts of people who can make the transformative steps to take something from a dream through to an operating reality. And that's far, far harder to do than it is to say. I think, everybody who promotes a company says, oh, look at our management, we've got marvelous management, and look at our ESG, we're doing all the right things in the community. Now, if they were all marvelous managers and doing all the right things ESG-wise, and probably had assets as good as what they say they are, they'd all be getting into production without any sort of issue. But, the odds of going into production, just looking at the number of companies and the number of new projects, is it's less than 1 in 10. So I think I would make a comment that when it comes to people, integrity and capability just aren't as common as you would hope they are. So that's a key feature for us, is the people that we're going to be working with. And I guess the final part of it is casting our eye over what sort of capital investment is going to be required to take it from the stage that we're looking at it at to the point where it would become a development reality. There are some very interesting things that get peddled as potential projects inside of junior companies, but if you're capitalized at $25 million and you're talking about a project which will have $1 billion capital spend, trying to make that work, where's that money going to come from? You can make all sorts of postulations about how it will be raised, but trying to raise off of that very, very small capital base is incredibly difficult. So, we look to match reality with the amount of money which needs to be raised as well.
Yeah, that absolutely makes sense. Well, yeah, I mean, it should be kind of an interesting year ahead as let's see how the markets continue to move. But that pretty much wraps us up here. So Hedley, I want to thank you for joining us here at the Assay today.
It's a pleasure. Nice to talk to you, Amy. Thanks very much for inviting me on.